Thanks, Brian. So Brian touched on this a little bit. So we've got common stocks, thank you, that we just discussed, which trade on the exchange. And but we have a lot of different types of instruments that make up the capital markets. And I want to just touch on 4 of them. We talked about common stocks. We talked about bonds. Bonds are also known as fixed income. You'll hear that term a lot. So fixed income is the same thing as a bond. And it's a little bit of a misnomer, this term fixed income, because there are bonds that do not have fixed payments. And that's what fixed refers to typically. The most common type of bond will have a fixed payment, or what's called a coupon. And that is the income stream that gets paid periodically. It's a contractual obligation. Now, what is a bond? A bond is simply a loan. So for the issuer of a bond, that person is looking for money, right? They're trying to borrow. And when instead of going to a bank and taking out a loan, they will issue a bond that investors will then come and buy. And that the investor coming to purchase that bond is essentially giving a loan to that entity. So who makes up the capital markets right now? Who are the components? What are the components? So we've got issuers. Who are issuers? Issuers are corporations, right? Like Facebook we talked about. Issuers can be governments. If we're talking about the bond market, the biggest issuer of bonds on the planet is the US government. The US Treasury bond market is the largest, most liquid market in the world. And so the US government is a huge issuer of bonds. State of California is an issuer of bonds. Just within the state of California alone, there are 6,000 different issuers. And these might be local school districts, they might be your local city, county, and all the way up to the state level. So just within California, 6,000 different issuers. So as you can see, it's a large, complex market. And that's where working with someone like Therese or Nancy, or to help you navigate through those markets can be really helpful. But we're going to talk about a couple of things, a couple of different ways that you can look at these markets and sort of distill a lot of this information to make investments on your behalf. So the other players are the intermediaries. Who are the intermediaries? Those are going to be investment managers. So those are big global money managers that can manage money on your behalf. They purchase and sell securities for you. Then there are also broker-dealers. Schwab would be a broker-dealer. And that's someone who is in the middle of a transaction. We match up buyers and sellers via the exchanges that Brian talked about. And we will act on your behalf in order to execute a transaction. So Charles Schwab would be considered a financial intermediary. And the place where all this happens, because we want to focus on stocks largely, we're going to talk about other asset classes, but the places where all this happened is on the exchanges. And the 2 primary exchanges that we mentioned are the New York Stock Exchange, which used to be, I mean, if you think about the pictures you see on TV and of traders yelling and screaming and climbing all over each other, that's how the New York Stock Exchange used to work. It used to be an open outcry system where traders would literally have to yell. They had pads of paper. I have friends who used to trade on the commodities exchange. Was the same type of thing, and they would literally come home with pen all over their back from people climbing over them trying to get their orders in. And we've moved away from that. The advent of technology now has moved us into the more efficient world of technology. So the New York Stock Exchange is more of an electronic exchange where when you place a sell order, that sell order will go to the floor of the exchange. There'll be people there to make sure that this happens on an orderly fashion, but that will then get executed electronically. The NASDAQ exchange is another one that's purely electronic, and that's where a lot of the technology companies will trade, is on the NASDAQ exchange, and that is a pure electronic market. So those are the 2 principal exchanges where we trade stocks. Bonds are traded on what's called the over-the-counter market, or the OTC market. And what over-the-counter means is that it's a negotiated market. There isn't an exchange you can go to trade bonds. You have to call a broker-dealer like Schwab and place a trade, and we would have to then go out or place an order, and we would then go out and find that buyer or that seller on your behalf. So it's more, and it's a negotiated market. You can't really look on a screen and see the price, unlike you would see Facebook. A bond market is a little bit more opaque. So it's not necessarily the same way that you would trade bonds versus trade stocks, although it all can be done online. But behind the scenes is where the differences happen. A third type of capital markets instrument is called preferred stock. And preferred stock is a pretty interesting product because it's a hybrid in between stocks and bonds. It's got characteristics of both. And it's a much smaller market. If we look at, it's around an $800 billion market. And if we look at the US Treasury market, the largest liquid market in the world, that's north of 20 trillion. So it's a much smaller niche part of the market. But preferred stocks tend to offer higher interest rates than do their bond counterparts. So a lot of investors look to preferred stocks as a way to generate additional income. So that's another component. And then lastly is the derivatives market. And Brian mentioned this, that with the financial crisis, there are a lot of different things that led up to the financial crisis. Derivatives get blamed at some point, but it's almost become a bad word. But there are very useful ways that you can use derivatives. We're not going to get too far into that because it's a much deeper discussion. But derivatives are a way that you can potentially protect your portfolio. But it's just good to be aware of how these interact with each other. So I think we're going to move on to building our investment foundation, and I think it's important to know that as we navigate through these products, thank you. I'll take that.